Good morning, good afternoon, good evening, wherever you're watching me today. My name is Peter. Welcome back to Invest with Peter. So today I'm going to be talking about, the recession that people are talking about that is going to be coming in the next 8 to 18 months and all that stuff. But today I'll be reviewing what happened last week, what I think you guys, my subscribers, should know, what you need to understand about why market is going all over the place and all that. So I'm going to be talking about that briefly as well, while I will talk about why I still believe recession. The signal is giving us, the market is giving us that there's going to be a recession, but I still believe we're not there yet. But there's a big signal which I'm going to be telling you, if you can wait till the end of this video, what I'll be telling you to watch out for, that definitely tell us that yes, we're going straight into recession. But we're not there yet. But I'll tell us the signal. I'm going to say the signal, which is not the yield curve, not the 2-year yield and 10 years that people mention. No, that's not what's going to send us a recession. But I'll be telling us, if you can wait till the end of the video, what will definitely push us down to recession. But before then, I am Peter Ads. I talk about finance, money management, stock market, cryptocurrency, market review every Monday. I put out my video there every Monday. So if you're just seeing me, or if you just come across this video, try to subscribe, like, and put your comment down below. That's going to push the channel up and we're going to have more views. So if you can do that for me, thank you very much. Today, so we're going to be talking about, Biden spoke last week, and he was talking about he's going to be releasing 1 million barrel every day to ease the problem, the tension that we're having in the market, the crude oil commodity sector and all that stuff. So US has the biggest reserve in the world of oil and all that stuff. So, but because they've stopped producing oil and all that, because the green energy, environmentalists and all that stuff, they don't want US to be producing oil in mass again. But US has got the biggest oil reserve. So Biden actually promised that US is going to be releasing 1 million barrel a day. That is a good news for commodity market, for for common normal people, day-to-day people, people who actually go to the pump to buy fuel. That's going to ease the inflation pressure on everyone, whether we like it or not. But they're still negotiating with Iran deal is still going on. They're still negotiating to get more oil pumped out from that place, and it's looking at different places as well. Saudi Arabia is coming on board as well. Again, they're coming to their senses. That's what I'm going to say. Trying to help ease this pressure as well. So these are the things. But before then, something needs to be done, and that's why he's going to be pumping out over 1 million barrel a day. Another thing that happened last week was when Vladimir Putin actually demand Russian rubles, for the gas they actually, give to the rest of the European countries like Germany, France, Italy, and all that stuff. So that is actually going to be affecting, it's going to be negating the sanctions that was placed on them, because, nobody's going to be dealing with Russian by paying rubles anymore, because rubles is being sanctioned. So to fight back, right? So Putin was like, I'm going to be demanding, I want rubles in exchange. I don't want US dollar. I want my rubles just to, But the countries that are affected now, they're saying, well, it's not part of the deal. What the deal says, we're going to be paying you in US dollars. So we're still going to abide by what we sign up for regardless. But, well, Putin said from the 1st of April, we're going to know who has the power in the hand, who has the key to the tap. So if you don't pay me in rubles, I'm going to be turning off the tap, and that's going to affect countries like Italy, who are predominantly dependent on Russian gas and all that stuff. So Germany is going to be affected as well, but I don't know how Germany is going to navigate these, but well, we'll see what happens. So another thing that happened again last week was when Russian soldiers started pulling out of Ukraine cities, and people were shocked, like, okay, we didn't hear anything from anyone. They just started pulling out, and from major cities, and though cities like Mariupol has been destroyed, but they're pulling out towards the eastern part of Ukraine. So, but as they're living, boo traps and mines and grenade, they're leaving it behind. But that's not what we're talking about today. We're investors. I'm talking about how this is going to really affect the market in a positive way, right? So as they are pulling out now, that means there's good news coming, to us that, well, Putin is getting, seeing the reality of what's happening in Ukraine. They can't probably win this war. Yeah, he needs more money, to win this war. But the sanction is probably biting very hard at this point. So he realized, well, he's losing more soldiers and all that stuff. So he's pulling out his army from major cities. Before we know it now, he's going to be pulling out and going to, places like the place they took the other time. So I believe gradually good news is coming. The peace deal is still happening in Turkey, the mediating left and right just to make peace reign and stop the onslaught on Ukrainian soldiers, Ukrainian civilians and soldiers and everything like that. So I believe we still have the good news, at the horizon. Definitely the good news is going to send the market up. So I still don't believe there's going to be a big, market pullback and all that stuff. The market, like I said in my 2 or 3 previous videos, market is ready to rally. We just want good news from a big rally, and we're still on it at the moment. So another thing that happened is on I think was on Thursday or something like that. So people were saying, well, recession is here now, 10-year yield and 2-year has inverted. So this is a big signal for us that says, if recession is coming, this is signals that always show. It's been used since 1970s and since 1950s, right? But I'm not going to dwell on this much. I want you to watch this video. So after the video, you probably realize what I'm saying and you understand better than how I'm going to explain this. All right, you can watch the video now.
That we could all look to, that was so accurate that it had predicted every recession without fail since the 1950s? Well, there is. It's called a yield curve inversion, and the warning lights for another one are flashing right now. I'm going to tell you what the yield curve is and what it means when it inverts, why it's been such an accurate predictor of recessions for the last 70 years, and why we could be seeing another one soon. The US government pays interest to borrow money, and that interest rate fluctuates constantly on the open market. The longer it takes to be paid back, the higher the interest rate. At least that's how it works during normal times, when the economy is solid. So you see what's known as the yield curve. The further out in time you go, the higher rates are. As the economy struggles, you start to see the yield curve take on a different shape. And if things don't get better, you see the curve invert. A yield curve inversion happens when the interest rates on long-dated treasuries are lower than those on short-dated treasuries. When investors see the economy starting to struggle, they start to demand higher interest payments on short-term bonds. That's because bonds are less likely to be paid back when economies are in trouble. And the movement shows that the demand for money now is greater than in the future, a sign that the economy is slowing down. That tends to be a good signal that a recession is about to happen. The yield curve has inverted before every single recession since the 1950s. And the Federal Reserve has even said an inversion is a, quote, reliable predictor for an economic downturn. If you look at a chart showing the difference between the 10-year and 2-year government bond, or the 10-year and 3-month bond, it goes negative or inverts before every recession. Researchers at the Fed say that's largely because the interest rate on the 10-year note reflects long-term perceptions of the economy, while interest rates on the 2-year note are largely a reflection of monetary policy. When monetary policy is pushing short-term interest rates higher, but investor sentiment is falling, you can see the yield curve invert. Now that inversion hasn't happened yet, but the market is headed in that direction. So far this year, we've seen inversions of the 20-year and 30-year bond, the 5-year and 10-year note, and the 7-year and 10-year. The difference between the interest rate on 2-year and 10-year notes recently declined to the smallest it's been since 2020, when the US had its most recent recession. That difference, also known as the spread, has been compressing pretty consistently for most of 2022. This has been a result of continued high inflation, pushing up expectations for the Fed to raise rates, as well as worsening economic sentiment and worries about the conflict in Ukraine. One hopeful caveat for investors, and the rest of us who don't want to see a contracting US economy, is that an inversion doesn't mean an immediate US recession. The time between an inversion and a recession has varied from 6 to 24 months, and stocks typically perform well during that time. Things could still turn around, and the curve might not invert. We've seen that before. And to be sure, an inverted yield curve doesn't cause a recession. It's just a warning sign. So an inversion doesn't mean a recession has to happen. But I'm always skeptical of the 4 most worrisome words in finance. It's different this time.
you've had him said, recession is not like 100% that it's going to happen, but I still believe we can still manage to avert this looming recession that people say. But just last week, the job, numbers came out, and the market was expecting like close to 400,000 job, filled and all that stuff. But actually, the numbers, the data that came out actually beat the market expectation. That shows us that the labor market is still doing good. So regardless of what people are saying, labor market is still doing good. FOMC has said it that labor market is doing good. Apart from the inflation going up, though, there's different things, so many things happening, right? That's affecting the market, affecting daily activity, normal people and all that stuff. So, but at this point, we can't say it's going to happen guaranteed. It's not guaranteed, right? So, I believe market is doing well and all that stuff. So now, to answer the question I put in the thumbnail, that this is what is going to send us to recession, and that is the Feds. The Feds has the power to send us to recession, and they know this as well. They realize they have the power to send us to recession. So I believe they need to be very careful while raising rate. I believe the next rate is going to be up to like 50 basis points. Let's be realistic here, right? Let's be realistic here. I believe the next one coming is going to be 50 basis points. It has to be 50 basis points, right? So the next one that will be coming around June, I think is probably going to be, I'm not sure, but it's probably going to be 50 basis points again. Then the next one should be 25 basis points, because if they actually turn hawkish on this issue, the market is going to panic and it's going to send economy into the recession. So they know this as well. We understand that QE is done with, so it's QT now that we're dealing with now, quantitative tightening. We understand, we realize that's the only thing that can bring down the inflation. Inflation is here to stay. Let's know that. Let's understand that now. Inflation is here to stay. But to reduce the pressure of inflation, they need to tighten a little bit, but not to tighten it up to the extent that it's going to send the market into a tumble, or it's going to send the market into a big recession. Economy is going to tumble and all that stuff. If they are portraying themselves to be hawkish and handling this with hawkishness, if I can use that word, right? So the FOMC meeting that's going to happen, they need to be very careful. The market is very fragile. Economy is very fragile now. The only good news we have is the labor market that is doing good. Apart from that, there's no good news coming out of anywhere until Russia pulls out finally from Ukraine, right? That's good news as well on its own. The price of commodity comes down. It's a good news for everyone to ease the inflation. But apart from that, I think the labor market is the biggest good news that we have at hand at this point. So the Fed needs to be very careful. So watch out for the next FOMC meeting and what they're going to be doing. If you see that they're going to be tightening, like if they portrayed hawkishness, you need to be very careful. Start taking your growth, the growth stocks that you've bought, start taking profit. Because if this, though, 10-year yield and 2-year yield has inverted, all right? So, and whenever it happens like that, it takes up to 18 months before recession comes in. So if you want to be very careful, once we have a big rally and you see on the TV or on whatever you see on the news that FOMC, they're pushing this, they want 50 basis points, 75 basis points, that means they are being hawkish, and that is definitely, though I understand that the market needs to ease off a little bit of the gas, because QE has been, it's really made them to pump so many money out into the economy. They printed so much money that now we're paying the price of it. So the US is owing a lot of debt, which is affecting the economy at this point. So I know QT need to kickstart, but they need to be very careful. That's the only thing. So the only signal, once you see FOMC having a meeting and they're saying, well, we're increasing the rate, you're going to raise rate by 75 basis point, 50 basis point, then 75, and all that stuff, know that yes, the recession is definitely going to happen. You protect yourself by taking profit when and while you can. All right, guys. I remain Peter Haz. I'm going to bring you another episode next week, Monday, and I'll see you again. Please, if you've not subscribed, kindly do that now. Thank you, and you're welcome. Bye for now.